Hi everyone, it's Jack back with another video, and today I want to talk about Altria Group as the parent company of Philip Morris. An absolutely fabulous company to own over pretty much any time period. At one point it was the best returning stock in the stock market in the last 50 years. I think it's showing real value here. We're looking at a nearly 10% dividend yield, PE ratio at multi-year lows, right near its 52-week low, only just above that. $70 billion market cap business. Of course the industry has declined, as we'll see in a minute, but they're able to offset this so far with price increases because they have incredible moat due to the natural addictiveness in the product and extreme brand loyalty. So let's get into this. First we'll look at the P&L, talk about the industry dynamics, the losses in the tobacco industry in terms of revenues and how they're offsetting this, and how they're returning capital to shareholders, then a little on the valuation and what I think of this business. So here's the income statement, and you can see at the top, net revenues. Since, well, I suppose 2020, they've only really been trending in one direction. It's very hard to keep up with an industry that is really in secular decline. On the right hand side is only the year-to-date numbers so far for Q3, but they're likely going to produce less than $25 billion in revenue, looking at where they are right now. However, you can see a bit lower down, gross profit. This is only trending in the right direction because they're increasing this and offsetting the revenue losses with price rises. And this is essentially the bull case of this business, in my opinion. They're able to increase the gross profit, therefore operating income, which generally trends in the right direction with it, therefore earnings per share, and therefore they continue to have ability to pay outsized dividends and to fund buybacks. Essentially the bull case is that Altria can continue to offset this for years to come because the products have an inherent addictiveness. Now, if you believe that, then this is a stock that has extreme value here, in my opinion. It's currently trading at a 10% dividend yield, as I say, and paying out with a decent payout ratio. The key brand for this business, and easily the most well-known, is Marlboro, and that continues to gently improve its retail share despite the decline in revenues. So that improved its retail share from 42% last year to 42.3% this year. Now, that might not seem like a lot, but it's generally trending in the right direction. Sales are not decreasing, so I'm very happy with this. And although it is grabbing market share from other players, this has been a general increase, not by a great amount by any means. I think maybe it's totaled 1 or 2% over the last few years, but it's trending in the right direction and is not going down, which is great to see. Altria frequently produces these graphs in their investor relations reports, and it's showing adjusted cigarette industry declines, and you can see there's a sharp increase from Q1 2022 to Q2 2022. This basically increasing gas prices, increased inflation. This marks really the start of the big interest rate rises, and while it's a very resilient product, as I'm sure you can imagine, it has come under slight pressure, or rather the industry has come under slight pressure, and that has caused greater industry decline rates in the 8 to 9% range. It has come down slightly now to Q2 2023 and Q3 2023 it's around 7.5-8%, but this is a significant increase over the 6.5% we saw at the start of 2022. However, Altria is not really feeling the pinch as much as some of the smaller players here. The e-vapor market, which has long been seen as a potential growth outlet for Altria and a replacement of its revenue when the tobacco revenue goes down, has been suffering recently. While enforcement from the FDA's recent regulations has been inadequate and ineffective in Altria's terms, still, generally, it will eventually become more effective in my opinion, and this will be bearish for Altria. They took a big write-down on their dual investment than they did a couple of years ago, a massive write-down in the billions, and while they continue to engage with regulators, federal lawmakers, etc., there is probably a need for some sort of tobacco harm reduction opportunity for Altria to take up. There's a lot of 30 million adult smokers in the US that are all potential customers for tobacco harm reduction products such as e-vaping and things like that, but the regulation just doesn't seem to be going in Altria's way at the minute, and this is generally bearish for the business. However, as I mentioned, I believe the key clear business case and opportunity case for this stock is that revenues continue to decline, gross profit generally ticks up for the next 5 to 10 years, and that's all I'm really looking for with this business. It's not going to be a forever hold because the cigarette industry, or generally the tobacco industry, it will be struggling in 30 or 40 years, much more than it is now in my opinion. However, right now there's a big alpha potential here, 10% yields on the dividend buybacks. That dividend continues to increase. It's well covered by their earnings. They raised their dividend per share 4.3% recently. That's the 58th dividend increase in the last 54 years. Absolutely outstanding. They have $268 million remaining in the current share repurchase program, which is not particularly impressive on a $70 billion company, but it's definitely helpful. They have a reasonably healthy debt to EBITDA ratio. They don't generally hold a lot of cash on the balance sheet. Any cash they are using is for dividends and repurchases, because this is an incredibly predictable business from expenses wise. The dividend is continuing to increase. I think it will continue to increase, and probably continue to increase in yield if the stock doesn't go anywhere or goes even further down to where we're getting a really, really nice dividend yield of above 10%. I think that's enough of analysing the business trends here, because I think this is a relatively straightforward business to analyse from that point of view. I want to look into some of the profitability metrics, the return on invested capital, etc., because that's the real meat and potatoes here. First of all, the balance sheet, really bad cash to debt ratio, but that is because they don't ever hold a lot of cash. I'm not going to hold that against them. Cash reserves here of little over $1 billion right now, so nothing too impressive. In terms of, as we mentioned, debt to EBITDA of 2.81, not particularly impressive by any means, not the worst balance sheet you'll ever see. Really happy with the interest coverage of 11, meaning they have 11 times the interest to pay off. That's absolutely fine. And generally, I'm not really worried about any of this, even with a less than perfect Altman score in that grey safe borderline, because of the right hand side, the profitability metrics here. Again, relatively stable revenue, declining in single digits every year, but the gross profit is increasing, so that gives huge predictability, huge resilience. Gross margins, absolutely outstanding, nearly 70%. Some of the best you'll see in any industry and by any business that's basically not a software company. Operating margin of 56%, that is staggeringly good. Again, outside of software, maybe Visa and MasterCard, these are some of the best you'll ever see, particularly for a business of this scale. We're talking 56% operating margin on operating income of around $10 billion. That is absolutely ridiculous. Net margin of 33%. Again, they know what they're doing here. They know how to convert from operating to net margin really well. It's not the best for Altria's historical comparisons, but still really, really strong. All of these metrics look really, really good from a profitability standpoint, some of the best you'll ever see. Return on invested capital of 28%. That is absolutely ridiculous for a business of this scale and age particularly. Really, really strong. And basically every metric I'm seeing here, return on assets of 18, nearly 19% for a business with this many assets is absolutely ridiculous. So all of these metrics far outweigh the balance sheet problems, in my opinion, which I don't really think are that big of a problem when you have this predictability of income. Right before we do a DCF, I just want to look at some of the more basic valuation metrics. You can see the ones I'm most interested in: price to earnings or price forward earnings and price to cash flow. Now these are both price to earnings of 11, price forward earnings of around 9 times, price to cash flow of around 9 times, both far, far below S&P 500 averages, which currently for trailing earnings are around 21 times, and for trailing multiple free cash flow around 15 times. These are trading at significant, more than 50% discounts to the market, while paying an enormous dividend yield, earnings yield of nearly 9%. This just seems like, relatively speaking, a no-brainer as far as I'm concerned. When we see the predictability of how this business is operating, I don't really see any downsides apart from the problems with the e-vapor market. So if we plug in the metrics that we expect from this business, well, it has had excellent free cash flow growth over the last 10 years over an average of 10.4%. I don't think this is fair to expect going forward. I've put in a much more realistic, for this calculation, growth rate of 2% for the next 10 years and 2% for the terminal stage or the next 10 years after that, and a discount rate of 10%. That gives a fair value right now of $47.58, and I think these are exceptionally conservative numbers. You can see the earnings per share grew slightly above that this most recent year. It's grew slightly above that every year, really. So moreover, I'm pretty happy with that. This is a relatively conservative calculation. It's giving us a significant margin of safety versus today's stock price of $39. So that's a decent 20% premium. While I don't think this is by any means a stock to hold forever, I'm very happy to hold this business over the medium term. I think I'm going to be buying some shares in the next few weeks. I'm really attracted by that dividend yield. I'm really attracted by buying back some shares, and I think there's enough margin of safety built in here and enough upside to where I'm very happy with investing at these levels. Of course, that's just my opinion. You name it, what you think in the comments down below. I definitely don't think this is a hold forever business by any means. The industry is definitely declining, but I think they can offset that with the profits they gain right now. Let me know what you think in the comments down below. I'm of course not a financial advisor. All this is my opinion. You should form your own opinions based off doing your own research and due diligence. Remember, your money is always at risk when investing in the stock market. And let me know what conclusions you come to about Altria. Do you think it's a value trap? Do you think it's a potential dividend trap? I'm not so sure I believe that at all, but I'm open to any discourse in the comments down below. Like and share and enjoy the video. I'll see you again next time.